morning, everyone, and thanks for joining us today. We're looking forward to sharing our key takeaways from ICSC with you this morning. Some quick housekeeping items. Please note that this presentation is being recorded and will be publicly available on our website for a period of time following the presentation. And some of our comments today may contain forward-looking statements. Please refer to our SEC filings for information about related risks. When we open today's discussion to Q&A, those on the screen, please feel free to ask questions verbally using the raise hands functionality. Everyone else can use the chat function. With that, I will turn the call over to Jim to introduce participants.
Thank you, Stacy. Of course, everybody knows Stacy. We also have on the phone Brian Finnegan, our President and Chief Operating Officer, whom most of you know. Steve Gallagher, our Chief Financial Officer. We also have, David Gerstenhaber, our Head of Leasing, Evie Gross, VP of National Accounts, and Laura Park Carson, a VP of our leasing team in the North region. So we really will be able to provide you with multiple perspectives in terms of what we learned at the conference. But I thought before we did that, I'd set the table a bit in terms of where we are as a company. As we talked about on the last quarter call, we are over 75% resolved on the tenant disruption space that we've recaptured at leases that are at spreads of over 40%. Importantly, and I think what deserves to be highlighted, is the quality of tenancy that our team is bringing in. Tenants like Sprouts, Ross, Dick's, Marshalls, Burlington, and others. But more importantly, you're seeing it in our traffic count, which is 8% up over last month or last year for April, and significantly above the peer group. And importantly, we continue to set up well the signed but not commenced pipeline. So with that, I'll turn it over to Brian for a more detailed discussion.
Thanks, Jim, and thank all of you for joining us again this year after what was another successful conference for our team. We went into the conference with a lot of optimism for a number of the reasons that Jim mentioned, based off of what we had executed during the first quarter and what we continue to hear from our retail partners relative to their expansion plans. And we really left the conference with even more positive, as expansion shows no signs of slowing down. And as you'll hear from our team, we're seeing it from a wide range of tenants, both in the core space, whether it's off-price apparel, whether it's specialty grocery, QSR restaurants, and many new tenants that we continue to add to the portfolio. You could see here on the slide just a small subset of the retailer meetings that we had, the 700 that we had over the course of 2 days, which again was another record in terms of retailer turnout for ICSC. And in addition, the conversations that we were having were for deals as we head into 26, 27, as well as moving things forward for a number of the box recaptures that we took back during the first quarter. I'll give a few other highlights from the conference, and then we'll turn it over to the team to kind of get their perspectives of what they heard at the conference. Starting on this slide, as I mentioned, retailer turnout was a record. We continue to see very strong demand from the grocery segment. You look at the grocers that are represented here, we had new locations that we're discussing with every one of them after signing deals with the likes of Trader Joe's, Publix, Sprouts over the past year. Interestingly, the Walmart conversation that we had in the 50 new locations that they're going to be doing across their pipeline, many of those are going to be Walmart neighborhood markets, both in existing markets and new parts of the country where they see infill locations, which is pretty interesting. We're always talking to retailers about new formats as well. We opened our first BJ's location in suburban Tampa during the first quarter. They're looking at a smaller concept. They've got one open today. They're going to be opening their second location in Florida to give them more opportunity. And they had a really strong quarter, which they announced today. We also opened our first small format IKEA store in suburban Atlanta last year. We continue to talk to them about those small format locations as well as their mid and large size formats as they look to infill locations across the U.S. And we continue to see really strong restaurant demand. We're at LOI or lease with every tenant that is represented here. And that trend of higher quality food and beverage tenant really continues across the portfolio. And we've been able to attract a number of them with the reinvestments that we've made across the portfolio, which Laura and David can touch on a bit more. So overall, I think it was really positive in terms of what we heard from our tenants during the show. And as you jump to the next slide, it really continues a trend of really adding great retailers to the portfolio, improving the underlying credit profile, which today is really the strongest it's ever been. And really what gets me excited as I look at this slide, in addition to the core tenants that we continue to grow with, or the percent of grocery anchored, which we've taken from the low 70s to over 80% today, which we expect to grow further with the deals that we have in the pipeline. It's just the sheer volume of new tenants that we're adding to the portfolio. This is a subset here. We almost couldn't fit all the logos on the page. As again, you look at the new tenants in the QSR restaurant space, higher quality, elevated brands that we're adding to the portfolio, higher quality service. And again, with that true north being just the strong credit profile of a number of these tenants, and really improved merchandising as we make reinvestments across the portfolio. And then jump into the next slide. I mean, speaking of elevated brands, we are seeing this convergence of elevated lifestyle brands, higher quality food and beverage, and grocery anchored retail happening across the open air sector. And it's happening in our portfolio as well. Laura can touch on a project that she oversaw in Newtown, Pennsylvania, where we've got a regional specialty grocer, and we were able to add our first new locations with the likes of Lululemon and Free People on top of our first location with Sprouts and a Capital Grill that we put into a Pier 1 space. We've seen similar things in markets like Naples, Florida, and Chicago, Illinois, with higher quality brands and food and beverage tenants. And jump into the next slide, it's continuing as we highlighted a number of our reinvestment projects out in Las Vegas. This first one on the left is the second phase of a Whole Foods development that we also did in suburban Philadelphia. And you can see some of the elevated brands that we're bringing in to reposition a theater opportunity. This is really front and center in Laura's discussions this week, as this is also in her portfolio. And then you look at another market outside of suburban New York, Rockland Plaza, where we've got three great off-price brands to join a great lineup of Ulta, J. Crew, and Shake Shack in just a fantastic piece of real estate across from the shops of Nanuet, where you see that convergence again of strong off-price core tenants and then higher quality food and beverage like Honey Grow, like Naya, that we're adding to our pipeline. And it's to a pipeline that we've invested over $1 billion over the last 10 years, delivered $200 million last year, and we see several more years of accretive reinvestment. And these projects are always things that we're highlighting at the show. And then jumping to the next slide, we're also filling our pipeline with new acquisitions as well. As part of the $300 million we closed on last year, we were able to add a fantastic opportunity in South Tampa in Britton Plaza, a center that fits very well within what we do here at Brixmor. Property had been underinvested in, well located, strong grocery anchor, and we feel the ability to, again, upgrade the merchandising here and do a very attractive redevelopment similar to what we're doing today in Davis, California, in Naperville, and what we've done in places like Naples. This project was front and center in a number of our meetings. The demand that we've seen out of the gate has been fantastic. And David and Evie, in particular, with a lot of their national tenants, have been working with our South team to deliver a plan that we expect to be starting to finalize deals on later this year and getting this into an execution phase in 2026, shortly after closing on the reinvestment. So overall, it was another great show. We continue to hear great demand from our tenants. The tariff discussion did come up in our conversations, and that was constructive as well. As I touched on, the brands that we're doing business with and the categories that we're doing business with, for the most part, are fairly well insulated. But it was also encouraging to see that many of those brands that could be impacted were looking at ways to mitigate this. And I think the overall arching theme, though, on this is demand for the retailers that we have been growing with is really not slowing down. And it was encouraging to hear from our tenants that they are focused on 26, focused on 27, and they continue to drive great traffic, continue to drive great performance in their stores, and really not showing an impact in terms of their pipeline. And so the last thing I'd say just before handing it over to the team is our team is what sets us apart. And you could see the energy, the activity at our booth. I thought that video was great. The picture is great. But one anecdote that I would say, we were meeting with one of our top 10 tenants. And as all of you know, to do these reinvestment projects, we generally need consents. We've gotten over 300 consents over the past year. And one of our key retailers said, when your consents go in, they go to the top of the pile. That doesn't happen without trust. That doesn't happen without being able to execute and consistently deliver for your retailers. And if you were to walk through the booth or you were at our party, what you would see is the trust, the relationships that the folks on this screen and our team has developed over time, and we're really grateful for it. So with that, I'll turn it over to the team. I'll ask a few questions, as Stacy said, to the group here, and then I'll turn it over to those on the screen for some questions as well. And then we'll also be taking questions from those that aren't on the screen, the chat feature. So feel free to put those there. So with that, Evie, Laura, David, good to see you again. Glad we all made it back okay. Why don't we first start off? I'll put this to each of you. How would you characterize maybe the overall tone of the show from your meetings, and what were your retailers really focused on the most during your discussions? David, why don't I start with you?
Yeah, thanks, Brian. Hey, everybody. So for me, it was business as usual for our expanding retailers. There was no sign of letting off the gas. As Brian mentioned, we had close to 700 meetings with tenants that want to both grow store count or relocate to our daily needs traffic driving asset class. Personally, the theme I saw or I want to hit on here today is grocery. I'm just humbled by the amount of grocery activity we have across the portfolio, and which was evident at the show. Brian mentioned 81% of our ABR is derived from grocery anchored centers, continues to grow. The sector itself has minimal tariff impact. The majority of their offerings are domestically sourced. And I've been in this industry for 20 years. There's never been a time where we've had so many different grocery tenants vying for space. What's driving the demand in that sector is continued positive momentum on traffic, continued growth in top line and bottom line, healthy financial stability, and most importantly, robust expansion plans. If you think about the breadth of names in this category, as you saw on that slide, Whole Foods, Sprouts, Trader Joe's, Publix, ShopRite, Aldi, just to name a few. And this isn't even the full universe when you take into account the regional and smaller grocers around the country that we're in discussions with. Our pipeline with Publix is the biggest it's ever been. We opened our first Whole Foods last year in suburban Philly at a really exciting redevelopment that Laura is going to highlight. In 2017, we had no Sprouts in the portfolio. Today, we have 9 with a number of additional deals in various stages. Sprouts was in our booth begging us for more Brixmor deals as they just approved expansion into 2 entirely new regions, both the Midwest, Metro New York, and all of New England. And even Walmart, which Brian hit on, who really hasn't been active in our portfolio lately, was at our booth looking for deals. That's my overall take on activity there. Let me give it to Laura now.
Thanks, David. Good morning, everyone. I thought the tone of the show was really positive. Echoing what David said, retailers were continuing with their expansion plans. Meetings were productive. As the VP of leasing, my team and I work really closely at the property level as Jim alluded at the outset, I'm part of the North region. So I have a specific set of properties within the Brixmor portfolio that I'm focused on. And a lot of our meetings were really centered on identifying opportunities within that cross-section of Brixmor's portfolio and advancing interests that we were aware of leading into the show. So overall, very good meetings. A lot of it is driven by the ongoing reinvestment in key centers through our redevelopment pipeline. That continues to create great opportunities. Had an exciting meeting with Chipotle about some out parcel opportunities in the portfolio. Grocers, as David alluded to, some great names out there, including Trader Joe's meeting, and continuing to bring new retailers into the portfolio. Some exciting meetings with the likes of Williams-Sonoma, Pandora, Warby Parker, and Chipotle. So very encouraged coming out of the show with the activity. Evie?
Thanks. Thanks, Laura, and good morning, everyone. I would just echo that the retailers were extremely persistent and diligent in pursuing their expansion plans and filling their 2026 pipeline. I had several retailers at meetings with their laptops out, plugging in addresses and figuring out which sites were fits for them. I had no-shows this year. And even one retailer who wasn't planning to come that decided to come at the last minute. So it really felt like retailers felt the need to be at the show in order to fill their pipelines in this supply constrained environment.
That's great. David, I touched on tariffs a bit. Did that come up, or how did it come up in any of your discussions that you had with your retailers?
Yes, certainly a hot topic, as all of you are aware. But for 48 hours in that convention center, I heard of zero pullback. Certainly not specific to tariffs. Messaging I heard was that people are aware and watching the tariffs, but confident that either things will be resolved or they will be able to navigate. So they're pushing forward. I think because there's little or no space and retailers are growing with pent-up demand, it was business as usual. I'm sorry. Growing with pent-up demand, no one wants to blink first. The competition's breeding activity, and most wanted to send the message that they want to be on the short list when there's retailer fallout and opportunity comes online. It was just business as usual. And there was a broad breadth of how I was hearing they were handling tariffs, both from a sourcing and pricing perspective. The scale allows larger retailers to negotiate sourcing. So while local tenants might be more impacted, it's only 18% of our ABR that's derived from them. And the majority of that universe of tenants are in categories that are not really impacted, like services, health and wellness, restaurants. So I remain very optimistic that despite the tariff conversations, we will continue to deliver on our value add strategy, Brian.
Good stuff. Laura, I touched on, and Jim mentioned this as well, just obviously addressing recently recaptured space. Your team's been doing a great job doing it. What was the conversation related to that as it relates to your portfolio? Were you seeing any retailers talk about this maybe increase impacting the supply dynamic, or how's that related to the conversations in terms of your ability and your team's ability to address those spaces pretty quickly? Maybe you can give like just some anecdotes around that and conversations on that space during the show.
Sure. As you said, Brian, there's been a lot of activity in my portion of the portfolio around these recently recaptured spaces. And really, I think what they're doing is creating opportunity today for us to improve our merchandising, to drive rate. That's proving out with some of the deals that we're already at lease on. We're seeing a broad cross-section of retail interests from a host of categories, including value, off-price, and general merchandise, all with strong interest in these boxes that we've recently gotten back. We've got 2 at least now that are going to commence in 2025, which is going to be a nice outcome for us. Excited to see that happen as well. But the trend is very positive. Lots of good meetings for these opportunities, and retailers recognize that this is a great opportunity to be a part of some of these really dynamic centers that they're eager to be in.
You mentioned deals opening this year, and while the bulk of those discussions that we've had as a team are for next year's pipeline in 27, 25 is basically filled. What I always love about the conference is there's always an anchor tenant that comes in and says, hey, I had 2 or 3 deals fall out. Can we fill in? And interestingly, the last meeting, our team was still, a lot of people were gone at 1, 2 o'clock in the afternoon on Tuesday. Our booth's still full. And one of the meetings that we had with Barnes & Noble was finishing up a lease to be able to get them open in a Joanne box later this year. So that does happen, and it was cool to see a number of those opportunities in addition to the ones that you just mentioned. Eddie, you get to see the whole portfolio in your national account role. You're working on projects like Britain, supporting the team, and you're also working with a bunch of new concepts. So maybe you can give or start in terms of some of the new concepts that you met with over the course of the show.
Yes, absolutely. A lot more fashion tenants, Brian. We met with Victoria's Secret, who is seeing some success in the open air space as they continue their expansion plans, especially where there's fashion co-tenancy and lifestyle like centers. We are working on our first deal with them at a redevelopment asset in Northeast Philly that Laura's team overseas, Roosevelt Mall, which we're very excited about. But the meeting in Vegas was really focused on finding additional opportunities for them in our portfolio. And it's just exciting to see their success in the open air space in addition to malls. And we met with PVH this year for the first time. They're the parent company for Tommy Hilfiger and Calvin Klein. They've just turned on an open air expansion plan to do 30 to 40 new deals a year for their two companies. And as they're seeing the wholesale business shrink a bit with some of the Macy's stores closing, they really want to establish a full price model and presence in the United States, because right now they're only in outlets. So that was really exciting. And they're following on the success of J. Crew Factory in the open air space and looking for similar co-tenancy. And then lastly, I'll just hit on Bloomingdale's outlet, which they just hired a brand new real estate person to oversee the outlet concept and expansion. And they're looking for 20 to 30,000 square feet in open air centers near full price Bloomingdale's. So that's really exciting and a great fit for our portfolio.
Yeah, and I think what's interesting too is kind of what's thematic across a few of those last ones you mentioned is value and quality, right? If you go in those new J. Crew stores, and we've opened a handful of them, just the presence layout of those stores, but also the value that you're getting. And it does really tie into the success that we've seen with off-price and the strength of the brands that many of those operators are carrying as well. And really, it's been cool to see how many of those brands have gone along with that trend, which is great. David, how about you on the new concept front?
Yeah, I take a look at the entire list of meetings we had in Las Vegas, and I'm super encouraged by just the breadth and width of categories. If I can hit on a couple of them, in the apparel category, Evie hit on a few, but we met with Cavender's, a Western wear and boots company out of the Southwest. We met with Fair Harbor, a Clicks to Bricks apparel company who's opening brick and mortar stores. Even LL Bean is looking to grow store count, who we haven't done anything with in a very long time. In the QSR and coffee category, we'd be here for 4 hours if I named them all, but I'll hit on some exciting ones. Naya, Flower Child, Honest Mary, Black Rock Coffee, Ready Coffee, Small Sliders, Swig Soda, and Lane's Chicken Fingers. Pet category, we had a bunch of new tenants at the booth. Canine Resorts, Veterinary Emergency Group, City Vet. Full service restaurants like City Winery and Gen Korean, who we're working on deals with. Even the entertainment category, there was a golf range operator called Rangeworks, who is like the smaller version of Top Golf. They actually put a net up and they can utilize a very small amount of space compared to the enormous footprint that Top Golf needs. The home category, we hit on Williams Sonoma and Pottery Barn. Blinds to Go was in the booth looking for deals. The discount theme stores like Miniso and Tesso Life. Tenants in the beauty category like Go Glow and Sephora. Those are the highlights of them. But again, if I had to mention them all, we'd be here for a long time, Brian.
We do have some more time, Laura, how about you? Just specific to your portfolio, and we highlighted a couple of those reinvestment projects that you and the team have done a great job on. Maybe any conversations around those to the new concepts?
Absolutely. I think, David in his role and Evie in the national accounts team, they're at the forefront certainly on Brixmor's behalf in meeting with these expanding and new concepts. And then being responsible for oversight of a portion of the portfolio, I get to be the beneficiary of seeing these deals actually happen in some of the properties that I'm responsible for. And I think that driven in part by our robust redevelopment pipeline and the needs of these retailers to start to explore open air opportunities, I'm really struck by the expansion of that list of first to portfolio tenants that are really doing deals with us in this space. And I really think, building on the heels of a project like Village at Newtown, which Brian mentioned, it's a affluent suburban Philadelphia market that we completely redeveloped around a really strong regional grocer, McCaffrey's, and it yielded, first to portfolio tenants like Lululemon, Free People, Chopped, and the Capitol Grill. And that type of demand is continuing to carry through to some of our other redevelopment projects like Barn Plaza, another Bucks County, Pennsylvania suburban Philly asset where, on the heels of the very first Whole Foods in the county, we are working on deals with Sephora and Sonoma and continuing to see brands like Pandora and Warby Parker come into the fold as well. So very exciting times, certainly, in these assets.
That's awesome. That's awesome. Well, thank you. Why don't we open it up to those on the screen? We've been here for about halfway through the discussion. Todd, how about you?
Yeah, sure. Hi, thanks. Appreciate all of the comments around leasing. Sounds like it was a very positive show in general with conversations across various categories. In terms of some of the uncertainty around tariffs and the overall economy, just curious, where you would expect to see some stress show first. Do conversations around leasing costs become a little bit more meaningful? Does it show up in collections, or are there other leading indicators altogether? Just curious where you'd expect to see any changes to the operating environment show first.
I can take that first. I think you'd see it just in terms of capital deployment. Well, first, as it relates to national retailers, right? It would start to show up in delaying potential store openings, right? Them coming to us and saying, hey, we're going to push this out till next year if they have the ability to do that. Delaying remodel discussions, and then ultimately just a pullback in terms of store count for next year. And we haven't seen it yet. I think those that could be impacted more are those that have significant offshore sourcing. It was encouraging to hear from those that have been successful, some of the ways that they've been mitigating that. They had been mitigating that in the lead up to this, since it's not the first time that many of these retailers are frankly dealing with tariffs. I think you'd start to see it there. And then from just a broader economic perspective, if there was a pullback, Todd, you'd start to see those discussions in collection rates. They've still remained strong with local tenants. You would start seeing retailers, both national and small shops, put stores at risk. We're not seeing that. We continue to see great renewal growth. You could see it there, right? If you're renewing tenants at lower growth rates, you'd start to see that come through in renewal. So overall, we remain pretty encouraged. We're watching it very closely, but particularly coming out of the show, we were pleased with how retailers were navigating it. I don't know, Jim or Steve, if you have anything else.
I would just add, I was really struck throughout the conference by the continued commitment to new store openings. The retailers have been resilient. They understand how to operate in an environment of tariffs. I think maybe the bigger concern, Todd, is what happens with the broader economic slowdown. But what was encouraging is that across the board in our core retail categories, you had focus on continuing to target new openings in 26 and 27, sort of looking through whatever near-term volatility they may be, and not in a Pollyannish way. The new store growth has been profitable for most of these retailers. So save a major economic slowdown, I think the retailers are differentiating between that near-term volatility that tariffs and a potential recession might create and the long-term commitment to their success in the open air format and their success in serving customers. And I think if there was a big surprise for me coming from the conference, it was just the breadth of demand. hopefully we gave you a sense of that. Certainly part of it's being driven by our value add strategy as we elevate and continue to bring new types of uses into our centers, but even our core categories. And Brian highlighted Walmart. They're actively now rolling out not only new super centers but their neighborhood markets, which is encouraging for us given the size of those boxes. So yes, there were tariff discussions in all of them, but I think it just needs to be put in the context of the broader deal-making backdrop.
Yeah, I'll just
I
add,
could,
I spend probably a little bit more time with some of our watch list tenancy, just understanding, what's happening with them as well. And I think that there is an opportunity that some of them are seeing with some of the tenant disruption that's happening, whether it's, taking over some of the more the party demand, or even with Joann's falling out as well. So I think, those tenants are still pushing forward and trying to take really advantage of the opportunity that may exist for them to take a little bit more share as they work through the next couple of years.
if I could just follow up real quick on that, are you spending more time discussing retailers' supply chains, and is that factoring into some of the leasing decisions that you're making now? You mentioned a lot of first to portfolio deals, higher interest from lifestyle oriented tenants. How is that factoring into your decision to
Well,
merchandise your
in the
centers?
most fundamental way possible, we're driving competition for the space, Todd. And obviously, credit and soundness of the retailer is an important consideration as we think about who's going to bring traffic into the portfolio. And what I highlighted at the beginning that I'm particularly encouraged by is you're already seeing the relative outperformance from a traffic standpoint because of all the historical work that we've done, all of the new tenants that we've brought in. But this competitive environment allows us to pick and choose the types of tenants we want. And, Steve is obviously a critical part in our assessment of their credit worthiness and, how their business model stacks up.
And I've said in a lot of meetings with those type of tenants, it's just understanding new to the portfolio, some of their financials, but also supply chain and other things as well.
Great.
Thank you.
Thanks, Todd. Why don't we head to Greg?
Hey, good morning. So with this supply constrained market, growing retailers with pent up demand that you mentioned, and what seems like a desire to be locating in the Brixmor portfolio, given a willingness to invest in and improve your assets, are we seeing a trend towards improving lease terms? Are you pushing for higher escalators, lower TIs, more control? Can you, provide some examples if so, or just generally talk about how lease terms have been evolving over the last few years?
Yes, yes, and yes. I mean, this is something that we have been focused on. All joking aside, I mean, you look at during the first quarter, average growth in the portfolio was 2.6% over all size ranges. When Jim joined the company, it was below 1%. Our in-place bumps are now about 1.6%. So that's been something we have been focused on. That's coming off last year of a record 2.5% growth. I think the other thing that we spend a lot of time on in leases is flexibility, right? It's flexibility in use and flexibility in development and ensuring that we don't have to get as many consents going forward. And that's been constructive as well. We wouldn't be able to do all this density that we're doing without freeing up some level of flexibility in our leases. And retailers aren't doing it out of the goodness of their heart either. They recognize the traffic that a new Naya brings to the portfolio or a new Honeygrow brings to the portfolio. So this kind of convergence of food and beverage, higher end service, anchors are letting us put these types of uses closer to their stores because they recognize the customers that are going there. And then again, we're doing fantastic from a recovery rate perspective in terms of how our operations team is deploying capital, but also how Laura, David, Evie, and our broader team are also negotiating our CAM clauses, just removing caps, reducing carve outs, all of those things to ensure that we're getting paid back for the investments that we're making. So the environment is allowing us to do that. The quality of the portfolio is allowing us to do that, as is competition for space. So remain pretty encouraged with what we saw in the tenor of those discussions as well.
Maybe
Thanks,
just
Greg.
if I can just get two detailed questions in on those lease terms. What are you kind of pushing for on escalators and small shop and anchors specifically? And are you pushing for fixed CAM as well?
Let's start with fixed CAM. The answer is yes. It's about 37% of our ABR today, primarily with local and regional tenants. Our fixed CAM growth rates across the portfolio are over 4%. And when we're setting those rates, we're setting them fairly conservatively. I think the second part of your question, we've been able to push local franchisee retailers. I mean, generally, we're closer to 3% across all small shops, but we're pushing them closer to 4%. Really in across the board. I wouldn't say specific markets, but we've been able to do that in a number of cases. Anchors, we're making incremental progress, right? I mean, historically, if somebody was 50-cent bumps or maybe 10% bumps in the 4 options, we're okay. Well, now we're 12.5 in 2 options or something like that. So we are making incremental progress there. And I'll remind everyone off what are the highest rents we're signing in the portfolio to date and off very attractive growth rates that we have in place. So that has been something that we've been pushing, and I think something that will continue to drive forward.
Great. Thanks, Brian.
Thanks, Greg. Caitlin, how about you?
Yeah, so you guys have those more apparel retailers that you were talking about. You also talked about how the grocery focus in the portfolio has increased. So can you talk about whether it's the retailers and what they want, or the shoppers and what they want? Like, how do those uses work together? And is it those kind of apparel uses are outside of the grocery portfolio, or are they even in like that relationship?
Why don't I give this one to Laura, because Laura mentioned the Sonoma meeting that we sat in, and they in particular have really seen that convergence of grocery anchored and higher end brands. And Laura's seen it a lot in Newtown and other projects he's working on. So Laura, what are some of the things that you're seeing there?
Yeah, look, I think having that best in the market grocer as your anchor, I think a lot of the retailers have recognized that the daily trips that brings to the center really creates an advantage for them to situate their stores in proximity to that. Our Village at Newtown redevelopment is a great example of that. I mentioned McCaffrey's, which is a regional high-end grocer there that anchors that project. Brian mentioned, our Whole Foods anchored center, Barn Plaza. They opened in March of this year. We're going to be making we have Sonoma there interested in moving forward with that. And I think they really see the value of being closer to the rooftops, closer to that daily needs traffic driver. And it's been a really successful endeavor for us in getting a lot of these retailers that maybe traditionally were in a mall environment or in a more regional location to recognize the benefit of being proximate to the rooftops. And I think for me, part of what's been really rewarding about that is not only did they commit and, we've completed our redevelopment, for example, in Newtown, but the retailers are thriving. And I think it's worth noting that the performance is there, the follow through is there, and they're thrilled to be in these locations.
And it's that performance that continues to drive the demand. Caitlin, again, was really impressed by the breadth of demand to be in grocery anchored and open air formats.
Okay, great. Thanks.
Mm-hmm.
Thanks, Caitlin. Andrew, how about you?
Morning. Thanks for the time. I think David mentioned local tenants are only 18% of ABR. But for those local tenants that do have tariff exposure, just any more details you can share on what they're saying around supply chain repositioning and tariff mitigation in general?
Yeah, I think our tariff exposure relative to local tenants, Andrew, is going to be more related to cost. I mean, you think of the bulk of our local tenancy, it's QSR restaurant, it's service tenants. Not as much in terms of true retail as it relates to the local credit. I think where we'd start to see more pressure there is what Jim alluded to, just a broader kind of economic slowdown. And we're just not seeing it. We're not seeing it as it relates to our collection rates. We're not seeing it as it relates to demand for that space from higher quality service and restaurant uses. You'd see it more there. I think what David was alluding to more is just that impact in terms of the economic slowdown, but also on costs. And I would say generally too, I mean, that benefit to this as well is we have seen, and you all have seen it, as retailers have been active at auctions over the past 2 years. more flexibility in terms of being able to take on existing conditions. And to the extent there are some cost increases, that flexibility will be a benefit here as well going forward. So I think that's the biggest impact that you'd see.
Okay, thank you.
Thanks, Andrew. Daniel, how about you?
Hi, good morning. It sounds like retailers have largely kept their store opening plans in place. So how do you as a landlord get comfortable with them expanding smartly and that they can remain healthy throughout the life of the lease given a changing macro environment?
Yeah, well, I'll give it to, I want to let David answer this. I would just start by saying what Steve alluded to, like we have the most stringent underwriting process that we've ever had in the portfolio. And not just for, we talked about local tenants and understanding what their business plans are, understanding who's signing the lease, but also with national tenants as well. But David, why don't you chime in a little bit more on that?
Yeah. Hey, Daniel. Thanks, Brian. So, I mean, Steve hit on this also. We are underwriting these tenants and what their ability to perform is, right? We're looking at their balance sheets. We're looking at their sales. We're looking at their growth trajectory, and we're understanding in a very detailed capacity what their ability is to pay rent long term. And I think that the health of the tenants that we're looking at who are continuing to expand, again, have minimal impact from tariffs and will continue to grow and be healthy in this portfolio.
And I think
Also, Daniel, sorry, go ahead, Steve.
Sitting through those meetings, right? They have their information on the side. I mean, I was in a meeting with David where, we're pitching sites and said, this one works, and they have their own dashboard with whether it be demos, traffic, all like how far their nearest store is. And then we have our dashboards saying exactly the same thing, right? So I think the amount of information that is informing these decisions about demand is as strong as it ever has been, and it's real time, which is really important.
And was just about to make the same point. That traffic data is most correlated with sales productivity. And so the tenants aren't making, they're making very well-informed decisions as to where they will be four-wall EBITDA profitable. And as I've said many times, it characterizes the demand from my standpoint as very durable. This is not speculative.
Got it. Thank you.
Great. Thanks, Daniel. Flores, how about from you?
Yeah, thanks. So it sounds like there were a lot of meetings that people had with services tenants. But one area that you haven't really talked about so far, or at least I haven't heard you mention it, Brian. I know this has been a big growth engine in everybody's portfolio over the last couple of years, Medtail. How are those discussions going, or what's the demand like, and how does what's happening to the insurance, United Health, et cetera, does that impact that business at all? Maybe if you can comment a little bit on that.
Yeah, on the latter, we haven't seen an impact, and medical is really a pretty broad range, but we have been pretty excited just overall in terms of the medical uses that we've been able to add to the portfolio. You mentioned urgent care. David mentioned vet hospitals too, VEG, which has been very active and been a great draw, and some of the performance that we're seeing there is very strong. And then Evie, we do have the kind of medical service and that shift, whether it's IV wellness, whether it's some level of like health and beauty component too. Evie, why don't you maybe touch on that relative to some of the medical uses or med service that you've been looking at?
Sure, Brian. There's been a lot of demand from high-end med spas, whether it's serotonin centers or a combination of laser hair removal and med spas from Sev Laser and Laser Away. And they all continue to have robust expansion plans and want to be near the Ultas and Sephoras and daily needs traffic of grocery anchored centers.
Yeah, and I think the other thing to that point, Flores, is even on those franchises, it ties back to the earlier question relative to who's signing the lease, what's the credit profile, how are you thinking about that business? What we're hearing from many of the franchisors, the numbers and the profitability of these businesses are fantastic. Some of the franchisees that are signing leases, multi-unit operators, several $1 million net worth. So we feel really confident when we're signing those leases, and we're also going into that understanding, okay, well, hey, what's the capital commitment that we have to put in? The last thing I would mention is that convergence as well, right? We're getting anchor tenants to agree to a lot of these uses. Some of the older leases just say you can't have medical, right? Being able to carve that out, or being able to be clear that those uses that Evie just mentioned are not true. It's not a hospital, right? Which they were trying to basically protect their parking. And those are some of the things that we've been able to get, even back to Greg's question, and clear up in a lot of our leases to add more of those uses. But it's certainly a category that we're excited about.
Maybe if I can just follow up a little bit, in terms of the rents that they pay, it's harder to see exactly, at least for us, how they're making money. Presumably, their occupancy costs are pretty reasonable. How do you track that? And are they good rent payers? In terms of the amount of rent that they pay?
Yeah, they're some of the highest rent payers that we have in the portfolio. Think of where all of you typically see medical uses. They're generally on out parcels, right? Those out parcels that Laura was highlighting at Barn Plaza, we're getting $75, $80 rents on, right? So that's the space they're generally competing with. So they're among the highest rent payers. I mean, we generally will get information from franchisors in terms of some of the profitability. It's generally tough to get sales numbers on some of those locations relative to occupancy costs. But we are seeing that the space they're going for, some of our most high profile space, they're competing for that, and it's among the highest rents in the portfolio.
And
Thanks,
some of
Lars.
those service businesses have the best margins, so that drives their ability to pay.
Thanks, Forrest. I want to make sure I get through everybody, so I'm going to hold to one question at the end we can get through if we can re-queue back in. But Michael, how about you?
I guess considering how strong the demand picture seems to be, are you ever able to write fair market renewal options into your leases?
Occasionally. I mean, it's not generally. We've been doing that. We've been doing that more. We've been doing that more with options. Now, I would just say broadly, we're getting rid of options, and this is something since David's taken over as head of leasing, we've even made more progress on, and almost eliminating those across the board with local tenants. But generally, particularly with small shops, we've been able to add a fair market value component, generally with a floor, going forward. So we haven't typically been able to get that in just pure CPI kind of rent growth increases in the initial term. But when we do have to give an option, those are some of the things that we've been able to achieve with local tenants and franchisees.
Thanks.
Thanks, Mike. Alex, how about you?
Hey, thanks. And thanks for hosting this. Just a question around inventory ordering. Obviously realize you guys are not really driven by percent rents. You're not a mall company, but still your tenants order stuff for back to school, for the holidays. Is there any sense that your tenants who source from overseas have adjusted plans or not continued with normal ordering patterns? Just curious what's going on.
Well, I think you saw a lot of pre-ordering ahead of the tariff announcement. That was pretty widely disclosed, that many of our retailers did do some of that. I think you have seen in the course of the last few months some additional shifting in terms of where they're sourcing, and heard some things relative to putting some orders on hold as the initial tariff announcement. I think it ultimately remains to be seen, but I think the one theme that we did see was a lot of pre-buying, but also a lot of ways that they've mitigated this over time. As I mentioned, they had shifted a lot of their sourcing during the last round of tariffs. I think you're going to see some additional shifting as well. It's something we pay attention to, but also I think back to Jim's point, the retailers that we're doing business with are generally seeing through this level of disruption. They're doing what they can to mitigate it. And what we haven't seen for those that we're growing with, and certainly could change for some, is a shift in their demand plans, right? Because the deals that we're talking about today, again, are for next year and for 27 for the most part. And that hasn't really come through from a demand standpoint yet. So the answer is yes, we're watching it. I think retailers are doing a good job as well as they can navigating it, but we haven't seen it impact demand. Thanks, Alex. Steve, how about from you?
Yeah, thanks. A lot of my questions were asked, but maybe just talk about TIs and just the overall cost of build out of stores today. What's sort of happening from a retailer perspective on that cost? How does that affect kind of the profitability of their stores? And, are there any supply chain issues that may be coming up kind of with tariffs that might kind of affect store opening timeframes? Thanks.
Yeah, I think we're coming off a year where we had the best net effective rents that we've ever had. We disclosed that to everybody here on the call. Interestingly, we track payback periods, and our payback periods last year were the best they've been in 8 years. I'd say we have seen costs go up in some respect, but it's leveled off to, particularly from a material standpoint, as it relates to roofing, HVAC and stuff. And when costs have gone up, we've been able to get that back in rent, and all of you can see that come through in the rents that we've been able to sign. One of the things that's been encouraging to us is how flexible retailers have been with existing conditions. And again, you all can see this in terms of how quickly retailers are able to convert spaces that they're taking over in auctions, that they're buying, that they're putting all their own capital in. Retailers have gotten very flexible in terms of their format and their frontages, how they're laying out the store to be able to fit into whatever space configuration that's available at the time, because ultimately supply has been so much in check that they have to be flexible, ultimately get store opens. So that's how we're mitigating a lot of this, Steve, is really understanding. We have the best understanding of our existing conditions that we've ever had. All of you can go on our website today. You can pull plans up for our vacancies. Our retailers, they're getting in the space. That may take a little bit of time on the front end with construction folks to get in and understand the existing conditions, but they're living with less useful life on the HVAC. They're living with maybe the roof with less useful life than they did 10 years ago, and taking more existing conditions today, living with the facade, the loading docks where they sit. So that's something that's been a benefit to offset some of the cost discussion. But again, ultimately, where costs are going up, we're getting it back in rent. Thanks, Steve. How about Teo?
Yes, thanks again for this. I just wanted to go back to the tariff question again, and also kind of tie in some of what Alex was talking about earlier. I mean, if people really have ordered their inventory, they're kind of fine for 2025. Ultimately all these tariffs, everything gets negotiated, and then you kind of know what the rates are in the back half of 25 going into 26. I mean, if you start to see some of the retailer pressure at that point, right? Then how do you guys kind of think about again rents, leasing velocity, and things of that sort? Again, it doesn't feel like it's a 25 issue, but I think there are a lot of us who are not convinced it could not be a 26 issue.
Well, I think, Teo, there's always a concern of a broader economic slowdown. And when you are planning for that from a business standpoint, you want to make sure that you're leasing while the environment is good, that you're improving the credit quality of your tenancy, which you're doing. And, we're talking about a long-term lease business versus a business that is as volatile as the underlying retailer business is. And, I think what we've proved through cycles is that this is a platform that can outperform even through a downturn. And obviously, a compelling part of that is our attractive rent basis, as well as the flywheel effect we've been generating throughout the portfolio as we bring in those better tenants. You see it in our traffic statistics. You see it in the relative outperformance of our traffic statistics. As Brian mentioned, you see it in our net effective rents. You see it in our NOI growth. I'm really proud of the fact that we're still going to be delivering 4% same store growth, despite taking back over 200 basis points of bankruptcy, as we've talked about on the last call. And for me, what was most encouraging again about the conference is it reinforced what we've been seeing week in and week out of our business, that the tenants that we want to grow with have capacity to grow and are doing so in a manner that's responsible. We're not seeing what you saw during the GFC, where you had retailers simply chasing new store count. They're being very deliberate about those locations where they think they can be profitable. The good news is there's a broad range of concepts that we want to grow with, that we can create competition and drive additional improvement in terms. So I like how we're positioned. I tend to agree with you. I think the near term Potential disruption could play out over the intermediate term, but I still think we're well positioned.
Thank you.
Thanks, Jim. Thanks, Teo. And then why don't we take a question from Linda?
Thanks, Brian. On your 1Q call, you highlighted 2Q occupancy would still see pressure from backfilling the open boxes, but then in 3Q, you see improvement. Based on the demand that you're seeing, is your sense that 4Q occupancy is still higher year over year?
Yeah, we typically don't give occupancy guidance. We want to be opportunistic when we can take space back. But I would say trajectory-wise, similar to what we discussed on the first quarter call, we do expect a bit of pressure as we take the Joanne boxes back this quarter and get back on a path to growth in the back half of the year. Now, whether that's exactly ahead of where we were last year or not kind of remains to be seen. What I can tell you is the pipeline's the highest it's been in 2 years in terms of the number of leases that we have out that we're negotiating. You heard from the team today in terms of the demand and backfilling that pipeline and growing it even further. So we remain very encouraged with that. But also that we continue to grow top line rents despite the occupancy drag, right? We grew rents 4% year over year in the first quarter, grew top line gross rent 4%, despite the fact that occupancy was down 110 basis points. So I think that gives you visibility in terms of how we're addressing the space, the higher rents, and then ultimately, again, just to tie up what we've been talking about today, the better credit quality of the tenants we're signing leases with. But that trajectory remains about the same that we talked about. Thanks, Linda. We have like 3 minutes left. I thought what I would do maybe here, since to end it, is just check with our team one more time. There's always some surprises that come out of the show. So maybe if everybody can say what was a surprise that you learned from the show that you weren't expecting heading in. Abby, why don't I start with you?
Sure. I would just say in the boutique fitness category, some of the players that have for a long time been only high street retail in very urban locations are now looking to be in open air centers in the suburbs, like Barry's Boot Camp, Core Power Yoga. Had some great meetings with them, and I think that they really like the lifestyle apparel and high-end grocery that we have in our shopping centers.
Awesome. Laura, how about you?
Yeah, I think for me, one of the pleasant surprises at the show was just the continued depth of competition for some of our centers. I mean, it's not unusual to meet with a retailer and have them say, oh, well, keep me in mind, I'm interested when you bring up a property. But I had retailers reaching out to me about fully leased centers, largely within the portfolio of assets that have been redeveloped. And they're saying, how do I get in here? I need to have a store here. What do you have coming up? Can you accommodate me? So it's really the sort of ongoing return, even post redevelopment for some of these assets where we've created such a desirable project that really is the center of that community. And that in turn continues to attract best in class retailers, creating competition and allowing us to push rate.
That's awesome. It's like the gift that keeps on giving at new tenants. Great.
Yes.
And then David, how about you?
Yeah, I mean, I think for me, it's just the amount of tenants out there, which I already mentioned, but the ones that not only are they reaffirming their expansion plans, but they're entering new markets. They're growing their pipelines to more than they originally anticipated. Tenants like Hobby Lobby, who said they're going to ramp up growth to 50 to 60 stores, and they're getting creative on ways to make that happen by backfilling weaker retailers, smaller prototypes, paying higher rents. Tenants like Ross, who's entering all of Metro New York City and New England, going to open 100 stores next year. Nordstrom Rack with 20 next year. Bob's Furniture, 20 new plans, pushing into the Southeast, which is an entirely new region for them, and plans to eventually finish out the lower 48. Just all these tenants who are out there looking to fill their pipelines. Brian mentioned Barnes & Noble was at our booth literally right before they turned the lights off at the convention. We almost got kicked out. They had their whole real estate department, and they were begging us to help them fill their 2025 growth pipeline, 60 to 70 new stores. Just super encouraging to see that.
Yeah. Awesome. Well, it's a good end of the show. It's a good ending for this as well. We always like doing this. We appreciate all of your questions. We appreciate everybody who joined us today. it's a ton of work that goes into this conference, and our team did another fantastic job. Our marketing team in terms of our booth, those of you that were able to visit our event, and we're really pleased with the progress and look forward to reporting on it more in the coming quarters with all of you. So again, appreciate the time, and we'll see you all again soon, many of you at NAREIT. Thanks, everybody.